traders, welcome out to your trading room for the week coming up, March 20th through the 24th. Corey here with you, and we've got a lot to talk about. Crazy amounts of volatility, but financial markets in turmoil, banking sector collapsing. Let's make sense of it together, and let's jump right in. So, last week's news. A review of last week is one to talk about volatility. So markets rebounded higher, huge outperformance in the technology sector. I do the market roundups on Tuesday. I'm actually going to be switching to Mondays going forward. But this past Tuesday, I talked about technology. QQQ looked like a setup. The only bullish trades I highlighted were tech names. And sure enough, the tech sector exploded higher, up about 5-6% over the rest of that week, Wednesday, Thursday, Friday. Huge outperformance there. Now, that makes sense if you understand that lower interest rates, better for technology. What's causing the lower interest rates is turmoil in the broader markets and risk of recession. So what got us into this mess was interest rates. The Fed has raised rates at a faster pace than ever before in history, and that's created some unintended consequences. Basically, banks are sitting on massive mark-to-market losses on their bond portfolio. Now, they own treasuries, which is money good, right? It's a cash equivalent because as those treasuries evolve over time and hit maturity, you know you're going to get your money back because it's backed by the U.S. government who can print money as needed. They've never defaulted and so on. So the bank's sitting there going, our treasuries are good. The problem is that they've gone down a ton in value because when we bought them, they had low interest rates. Now interest rates have gone up a lot. So if we want to sell them, we have to sell them at a discount to people. Nobody's going to buy the bond at par value when they say, well, we can get the same type of bond that's yielding a lot more. So if I'm going to buy your bond, you got to offer it up at a discount because yours has a crappy yield. And so these banks, why do they have to sell them? Well, they could hold them to maturity, and that was certainly their plan. But if there's a run on the bank and people come after their money, then you have to sell assets to return money. And so when there was a run on the bank at Silicon Valley Bank and so forth, they had to come up with the capital somewhere. They were locking in losses. Enough people coming to the doors and running on the bank. You have to sell enough assets and it can wipe the bank out. And some of those banks are never going to recover. They literally are going through bankruptcy proceedings. Now, here's the good news. When people get risk off, what do they run to? Well, they actually run to treasuries. And so oddly, because of the chaos, they've been pushing the treasuries up and yields down. That does relieve some of the stress in the banking sector. I don't want to say it's all of the stress, but some of the positives. So when I said that I thought the markets would have a nice rally on Tuesday, people probably thought I was insane. And what are you talking about? There's chaos and turmoil. Well, we had an exhaustion low, and tech specifically looked like it was going to move sharply higher, but the market in general. We've done that now, and we've gone up a few percent and a lot in tech. Where do we go from here? Well, I was just trading the markets higher. And as we talked about on Tuesday, if the markets give you that rebound, it's probably a nice shorting opportunity, and I think that's where we find ourselves. So as you look at the results for this past week in terms of economics, we had the CPI come in as expected, 0.4 for the month, still running at 6% yearly inflation. That had some really bad numbers, like core CPI was even hotter than expected, not what the markets want to see. The very next day we had PPI though, and that was a much better number. Now that's producer price versus consumer price index, but it came in lower than expected, and that was a welcome sign. Market participants are expecting the Fed to raise by less, but still raise rates at the meeting this coming week ahead. So as we look at the markets, where do we find ourselves, and more importantly, where are we going? So we had this push down, we had this exhaustion low, and all of the recovery pretty much happened after Monday's gap down. So when we talked about the markets and kind of where we were at and where we were expecting to go, I felt pretty good that we were going to push to the upside and have some recovery in this market. And sure enough, the S&P up 1, then NASDAQ up 6. but not everything is shining well. Gold and silver and Bitcoin, this is like the perfect recipe for them. If you say, why would anyone want to own gold, silver, Bitcoin? The perfect response would be a lack of trust and faith in US dollars or currencies around the world, global turmoil in the banking sector, risk and lack of trust in the Federal Reserve and central banks around the world. This is like the perfect roadmap. So, not a huge shock and surprise that gold, silver, crypto are doing well. I think the explanation for why oil just got hammered down 13% is one that they're pricing in a recession. And basically, market participants were on the fence. Will a recession arrive? Is it going to be a soft landing? I think this pretty much puts in place that a recession is coming. Most market participants expect that, and frankly, it's very likely now because the banking sector is going to have to play it conservative and safe here for the short term. Are they going to be in a hurry to go out and take a bunch of, give a bunch of loans and give away capital and so on? No. The banks are going to clam up. They're going to say, we're only doing business with the very best deals. We're just going to play it conservative here for a while. And that's going to slow the economy amongst other things that we're already slowing. So I think the economic recession will be seen in the coming next couple of months. And in fact, the yield curve we'll talk about also suggests that that's coming. So oil is very, very economically sensitive, and the expectations are just really getting priced in right now of the recession. So as we look at the markets and the chart, what I think is happening right here is basically a bear rally. We thought that there would be a nice bounce, a nice recovery. You can see we were extended away from the moving averages down here, the gap down. It was pretty clear that we would get some, well, this market, you can never guarantee, but this market has given you those rallies and those opportunities to short, here being an example. In fact, when I thought the markets were going to bounce here, it really didn't bounce until a couple of days later, and then the big shot up. Here we timed it a little bit better, the nice shot up, but where do we go from here? This is a bear rally. This is a bearish harami, Japanese candlestick pattern, harami coming from pregnant or body within. A little bit of a bearish indication, a sideways day. You could correct back up a little further, but I suspect as we look at the sectors, it's going to look bearish across most sectors and most areas of the market. We talked about in the QQQ, it was just a fantastic setup. And if there was anything to buy, it was tech. Now, we were below this channel when we were talking about buying. We were back in here, but ultimately expected that we would break out of this bull flag. Here's the flag pole. Here's the flag waving in the wind and the nice breakout. I was not playing this as though tech is about to go up and never look back, that we've hit the bottom. No, no, no. This was a bottom. This was a tradable bottom. Certainly an area to consider taking profits on bearish trades. That would be the first obvious answer is if you have bearish positions, and I was pretty loaded up, I had about 80% of my trades bearish at this time, the first thing is take profits and take some money off the table if you felt like I did that we had hit kind of an exhaustion low, that this was, it had now played out. And in fact, I would have expected more if there wasn't some solution that the market was taking care of itself, right? As I talked about earlier, the interest rates falling back, bond market rallying because people were going risk off, actually relieved some of the stress. And this was part of why I thought this was just an excellent area to expect a reversal, because a lot of the solution to, a lot of the things that could have gotten a lot worse here were off the table because the market was taking care of it. Because people panicked, that set a floor and that created a nice area to first take profits in your bearish trades. Second, if you want to be more aggressive, you could even consider entering bullish positions. And my argument was certainly on the side of tech. It was what I really pounded the table on, the only things I highlighted, as I mentioned on Tuesday, were technology stocks. Now here's the VIX. And the VIX has given some signals, again, of that exhaustion high. Usually when you get these long upper shadow candles like this, if you were to go back and look at the VIX over time, these are good indications to play the market for a bounce. It doesn't mean it's the bottom. It's likely to be a bottom. Well, now we've seen that bottom and we've bounced. Where does the VIX go from here? It certainly acts like maybe it wants to go on another run. It's not falling to pieces, it's high basing. I think there's another shoe to drop. Financials show no signs of stabilization. That's right in the eye of the storm. The VIX is high basing here. It's not really giving a lot of ground. It's back and forth, up, down, up, down, up. I suppose on Monday you could get it down, but I think it's going to be up on Friday, up on Monday, and start to work its way for one more push. That extra push and whatever's happening in the financial sector seems like it's going to play out a bit further. This coming week, so we just passed options expiration Friday, the third Friday of the month, the monthly expiration. Now we kind of get a refresh as we come into the FOMC. So all of those March monthly options are gone. Now we move into the April cycle. The VIX, interestingly enough, was slightly higher on the week, even with tech and some of those things rebounding. And I had a trader, after I did the Tuesday market roundup, I believe it was Wednesday, I had a trader reach out and say, wow, I've never seen this before. Tech is flat and the VIX is up 15%. And yeah, it was kind of strange, right? The VIX was up that much. Usually if the VIX is up a lot, then the market's down a lot, and yet tech was hanging in there. And sure enough, it was a market tell. There was a reason it was holding up, and there was more buying interest that came into that. The FOMC meeting is expected to bring 25 basis points. There was a report out late Friday that the Fed is still going to move on with that path of 25 basis point hike, moving the Fed funds from 4.75 to 5%. This is probably good news for the markets in that wouldn't it be worse if the Fed was so nervous about what's happening that they cut interest rates altogether, that they cut them or even just kept them the same? It's kind of a good signal that the Fed is not so worried about the financial sector that it won't even raise by 25. Now remember, they were going to raise by 50 before the financial debacles of SVB and these other banks. Now they'll raise by 25, but if that happens, I kind of see that as good news. It would be worse if the Fed was so nervous and so afraid of what was happening that they didn't cut at all, or they started to cut rates or do something like that. That would be a big warning sign. Remember, whenever the Fed comes out with a surprise meeting halfway through, when they're supposed to report or something like that, that happens from time to time. If the Fed had to do an emergency rate cut or something, those are bigger risks. Now, a lot of what's happening this week, remember that when you look at things, you can put them into categories, and I call it known unknowns, unknown unknowns, etc. And this is a great example of what's happening in the banking sector fits in the category where you can see a lot of volatility and a lot of follow through. Most of the news you get every day is a known unknown. It's just market noise. Oh, this company beat on earnings. This company missed on earnings. The Fed is going to do this with rates, etc., etc. These are all known unknowns. We know the date and time that these companies are going to report. We know the date and time of the FOMC press conference and their statement. These get priced in ahead of time. And even if they're not fully priced in, the market's prepared for them. They know it's coming. it has a chance. The market's very smart and it's able to price these things out, really figure out ahead of time where's the Fed likely to be or what's this company doing, and they have channel checks and so on. So most of the quote unquote good news or bad news that comes in, it's priced in to a large extent. Sure, there can be a little movement, but when there's good news, it's probably more of a take profit. When there's bad news, it's probably a take profit on your bearish trades. It's just not a major difference maker. When you have unknown unknowns, these have had no chance of being priced in. And we got one, and we get a few of these every year, right? Sometimes it's sector specific, sometimes it's across the entire market. Examples of unknown unknowns are like these bank collapses. There was no schedule, no plan for this, no way that it got priced in because we didn't know it was coming. And then you have all the unknown ramifications, right? When a company reports earnings, we know it's coming, we're prepared for it. We just don't know exactly the numbers they're going to report. The same thing with the Fed. Here, we've got unknown unknowns. It came out of nowhere. It caught the market off guard. It had no chance to be priced in. And now we have to figure out all of the ramifications. What does this mean for interest rates? What does this mean for the US dollar? What does this mean for this sector and that? And now we've got to make determinations. And these drive volatility. If you are saying where is there likely to be more follow through, it's when you have unknown unknowns. So for the financial sector, is it likely to have more volatility around this? Absolutely, because there was zero chance it was already priced in. And it's directly hitting the financial sector. Now, some other markets, this is kind of a market event, really, because it's changing Fed policy and so on. So it's an unknown unknown that, of course, has fueled even more volatility in the broader markets. So whenever something like this comes out, really stop and ask yourself, is this a known unknown? In which case, it's probably priced in, and you still need to look at it and say, well, what are the unintended consequences and so forth, but it's just not as big a deal. When you have an unknown unknown, and this is a prime example of one of those, it's just not priced in, more volatility, more follow through. There can be a complete repricing of gold. There can be a complete repricing of the US dollar, of interest rates, of whatever, of stocks, of the financial sector, a complete repricing because it was not priced in any way, shape, or form. Now, I mentioned that economic recessions, historically, when the yield curve moves from inverted and gets uninverted, gets back to normal, the recession is usually there 2 to 4 months later. So that puts us, right now, it's basically going to an uninverted state. I think that's how you say it. Recession should be about 2 to 4 months off, is when we're kind of in the recession. Now, remember, stocks, the entire stock market will bottom out usually before the recession is even done. But our bottoming process, if you use history as somewhat of a gauge, it's probably going to get a bit uglier in stocks before it gets better. I would certainly anticipate that that's the case. Now, there can be bounces, there can be choppy trading, but a sustained bottoming point in the markets is probably a little while off, will probably happen while we're still in the recession, but that puts us more later this year. And that really fits with my overall big picture outlook for the markets in general. So as we look at this upcoming week, the big highlight is obviously the FOMC. That's the big event. Then you have a couple other things, new home sales, you've got manufacturing and services PMI on Friday, but it's all about the Fed this week. Now, weekly, monthly outlook, we are below the 20, we are below the 50, they're now sloping downward. Tech is outperforming, but even in tech, I think that trade is basically done, personally. I think the trade was a nice rebound, a breakout of that bull flag pattern, but not a breakout that just keeps going and going and going, a breakout that basically exhausts to the upside. I think we've got that exhaustion spike on Thursday, and tech should start to fade away. I think most everything looks like to my eye that it's going to trade lower. So let's break down sectors one by one and make sense of this together. The two sectors that absolutely got annihilated are financials and energy. Materials, bad week. Industrials. And if you were to ask me, what are the areas that are most sensitive to an economic recession, I'd name all of those, and then I'd also add consumer. I would put consumer in the list, and consumer held up relatively well. But basically, everything that was dependent, more cyclical, moves more with economic ups and downs. Every one of them down except for that consumer space. So that was kind of interesting. The things that outperform, again, tech and then communication services also kind of an outperformer. As we look at the week, pretty dispersed between sectors, some good, some bad, some in the middle. Interesting that the markets as a whole actually bounced a little bit in the S&P. So as we look at these individually, XLU, if you follow Elliott Wave, that looks sort of like a three-step correction and likely to push back to the downside. So XLU doesn't look great to me. It's a little bit stronger than a variety of other sectors, was up a little bit this past week, but I would still expect more of a rollover here. Communication services holding up well, and you'll see out of the charts that are holding up, this one and tech stand out certainly. So XLC, you're above those moving averages. I would call this more going sideways for right now, while the rest of the markets are still in more of a downward trend. Real estate, still in a downward trend, lower swing highs, lower lows, everything still pointing towards lower prices. So bearish on that front, -2 in real estate. XLI, industrials. Again, this is an area of the market that is cyclical, that moves with the economy, and the economy is expected to get weaker. I would expect XLI and the industrial sector should probably get weaker. But a few of these sectors did kind of put in the exhaustion bottom that we talk about. A hammer-like candle, increased volume, just an indication that they would bounce for a period of time. Healthcare, still downward trending, similar to the S&P in that it has that bearish Harami type formation underneath the 20 MA. Still looks more bearish than bullish. You can see the increased volume, that exhaustion low, but probably not something that looks like it's about to break to the upside. Still looks heavy, still looks like as it tries to bounce, there's more selling, more supply that hits. Financials, this is a broken chart, and it's anybody's guess where this thing is going to go. Right now, I don't have a strong opinion. It obviously more bearish looking than bullish, but it's just going to have a ton of volatility. And what you're going to find is that you could almost throw out a wild guesstimate, and it might exceed that. You could say, well, might be going from 30 down to 25, which is a huge move from a sector standpoint, to just move down 16% or 20% or something, and it might blow right through that. It's just anybody's guess. There's obviously some things happening there that are horrific. Now, here's why it's hard to short. I mean, you're so far extended here that it's due for a bounce. It's due for some sort of correction, but it shows no signs of being a bottom. So my guess is that when you do bounce, it probably fades off pretty quickly. XLY, the consumer space, out of all the sectors, this one probably looks the best to my eye for a short right now. We're right up against those moving averages, which have just rolled over. And assuming that we roll over on Monday here, you'll pivot over, lower swing high, should come back down and test those lows and such. XLY looks bearish to my eye, so I would, in terms of price action, it actually did outperform. That's the only thing that I can say is that theoretically it should have been down last week and it was up. So that does give you a little bit of pause. Technology back up towards the highs and even broke to new highs. Look at that. A little bit above where that resistance was. So made a new multi-month high this week amidst all of the deterioration in broader markets. Are we going to take off to the upside? Probably back and fill here, and then we'll see. If the market is really going to keep going up, there's probably going to be a decline further for a couple of days, and then something, I don't know if it's Fed meeting related, whatever, fuels the next surge to the upside. And I'll be watching that tech chart to see if it sets that higher low and can really take off to the upside. Anything it tries to do here, like imagine on Monday it tries to break higher, I'd be inclined to fade that and fade it back down. I just don't think we're in danger of this thing running away to the upside. I think the trade was to play it higher here, and we did that, and now I would be more wait and see and not really trusting any upside breakout. Material sector still downward trend, big sell-off, choppy down here at the lows, but still looks pretty bearish, below the 20, below the 50, and energy. The single worst, this sector was worse than financials. This is what happens when the best of the best just changes trend, and you've gone from a bull market cycle in energy for the last couple of years. It was the only thing last year, the only sector that was up, and a lot of that is coming unwound. So the expectations, the bull market is kind of being broken here, and the expectations are that energy is going to suffer right along with everything else as the economy goes into a recession. The good news for energy is probably towards an exhaustion low. So if you were trading it to the downside, you may want to take some profits on that bearish trade. And then sort of like we talked about in the markets last week, reshort, reinitiate the bearish trades after a bounce. I feel like energy today is where the markets were last Tuesday, this past Tuesday, when I said I thought that there would be a big upside move, and especially in tech. I think energy is kind of like that it's going to bounce. Notice of the two, financials look like this and energy looks like this. Out of the two, I trust this exhaustion low in energy more, and it just shows better signs of bouncing. It shows that more probability of a bounce, whereas financials are just, they've collapsed, and even last week a little further collapse, and they just can't get out of their own way. So I'd expect something like that where financials are just more sideways even if the market rallies. Energy could see a nice pop to the upside. Longer term trend though, definitely in danger of breaking down here. So that's how our traders looked at it in terms of ranking the sectors based purely on the charts, just based on, are you trending up or trending down? You've got to look at each one, kind of fit them into where you think they're at in the process. If you think that there is an exhaustion high, an exhaustion low, like I don't really trust. If you were to ask me, how will the next week go? I would actually expect energy will outperform technology, even though the charts aren't really set up for that long term. In the very short term, I'd expect that to be the case. So it all depends on time horizons, right? If you ask me which one's going to be better 6 months out, over an extended period of time, well, then you might say, well, tech certainly looks a lot better and it'll probably outperform big picture. That's probably true, but in the short term, energy looks like it might outperform. First up, the utility sector. So our first trade idea, American Water Works, symbol AWK. You could play this just as a bear rally pattern. Possible trade idea would be a buy the 140 put, sell the 135 put. The idea here being just play it to the downside back towards those lows. Ultimately, the utility sector tends to be kind of a slower mover, so be aware of that. Communication services next. We were looking at Spotify. Look at how well it's held up in the broader markets. It's really a perfect ascending triangle. You can see the higher lows, the tight consolidation there. Expectations would be that it hangs in well relatively compared to other markets. You could buy the March 125, sell the March, or buy the April 125, sell the March weekly 130 calls, or maybe even target a little bit more out of it, but ultimately should continue to be an outperformer as it looks like to our eye. Healthcare sector, trade idea, Novocure. Here you can see just deterioration, massive selling. It did have kind of a big gap down at the end here, so probably, frankly, is just going to kind of consolidate here for a few days. You could play it as some sort of diagonal put spread, maybe even get a bounce before you initiate. That would be probably my preference, but ultimately, that's a chart that looks like we're going to continue to deteriorate lower. Industrial sector. So here we've got AZEK, just kind of a low basing pattern down here towards the lows. Possible ideas would be a bear call spread, sell the 20 call, buy the 22 call, play it to be in this range or lower here over the next month or so. Financial sector, this one obviously has just been littered with potential bearish candidates. Here's KeyCorp, a regional bank. The regionals were hit especially hard because consumers and businesses are just looking at it as, why would I want to take the risk that this company is going to go under and I'm going to lose all my money for no reason? Maybe I'll just move to a larger bank. And so regionals are probably losing business and getting hit extra hard. Here we've been in a little consolidation. If you anticipate further declines, you could play the 10 to 12 bear call spread, expecting it to finish below 10 at April expiry. Consumer stocks, Lowe's, been in a consolidation here, big bearish engulfing pattern, one of my favorite candlestick patterns to trade. This one you could do a targeted butterfly or neutral type of butterfly where you're just playing it to be in this range or possibly lower. I don't mind kind of targeting a little bit lower price maybe on the body of the butterfly, but ultimately Lowe's consolidating here and looks like we may start to break, starting on Friday, really start to break down from here. Volume picked up, bearish engulfing pattern, looks more bearish overall. The technology sector. So this is outperformed. First Solar is kind of a hybrid. It's sort of tech, it's sort of energy, obviously solar and whatnot. Here you're in a bull pullback. Relative performance is through the roof. This thing has been making new highs even in the chaos of the markets. If we hold at these levels, you could play it as a little diagonal call spread back for some bounce, some push back to the upside here in the near term. The materials sector. So materials and energy got hit extra hard. Lithium America, low base pattern here. Play it possibly as a bear call spread, sell the 18, buy the 20 type call, playing this stock for further declines to the downside. And then last but not least, we've got energy, which again, we talked about energy has just been deteriorating. You could potentially play Apache to just kind of be in this consolidative mode. The targeted area here for this diagonal would be one where you'd want it to finish on March 31st in 2 weeks at around $30 per share. I personally kind of anticipate that energy might have a bounce first. It seems more likely to me to bounce than financials, and both have been in a free fall. So I wouldn't mind if we got a bounce, maybe initiating bearish trades there. But to my expectations, I'd expect a bounce is coming in the energy sector. In conclusion, obviously markets have deteriorated overall. Even with this week's recovery in tech, I personally am just not convinced that that's the end of it all. It could be a little choppy in here for a few days as we get into the Fed meetings. There's more really as you kind of line things up. There was a good setup for to play the markets for a bounce last week, but that ship has sailed. And buying here doesn't look like a great risk to reward. So if you didn't buy it lower prior to that multi-percent move, I think at this point you've got to wait or play it bearish. I just don't see a great bullish setup for the markets generally. We could see some exhaustion type days. Your portfolio allocation and taking profits and doing those sorts of things are going to be critical. As always, stick to your plan. For the week ahead, we've got the market roundups coming out midweek on Wednesday and market roundup on Thursday. I personally will be switching. I'm going to be moving from the Tuesday market roundups to the Monday market roundups for the foreseeable future. And Joe will be doing the Tuesdays. Rob will stay on the Thursdays. So a little bit of a switch in our uh, market roundup, and we do that from time to time. Hope you've enjoyed this trading room. Everyone have a great rest of your week, and we will see you next time. Goodbye, everyone.